welcome back to my channel A-Level Accounting Guide. Now we'll be continuing with the question number 4, which is related to ratios. So there are a lot of ratios in A2 and also in AS. So here's a brief summary of all the ratios that you need to learn before you solve this question. Alright, now we'll be looking on towards the question. It says the equity and the non-current liabilities of WPLC at 31st December 2020 are as follows. And now we have all the amounts stated of the equity, like for instance ordinary share capital, 8% preference share, share premium, retained earnings, and you have the total equity, and also the non-current liability, which is 7% debenture. Now the A part states that you have to state two benefits of each of the following groups of issuing the preference shares. So what are preference shares? Basically, preference shares are those shares which are issued to the shareholders, which will receive fixed dividend. It's just like debentures, but they're in the form of shares. So they are paid before the ordinary shares. When you wind up the business, they are paid all the assets taken over or anything that they receive before the ordinary shares. So they are paid before that. They are also long-term loan certificates, and they are not the shares. They're just as debentures, you deal with them. They're just like that. Alright, so now the B part states that you have to calculate the profit from operations for the year ended 31st December 2020. So the following information is provided. Preference share dividend was paid, ordinary dividend was paid, proposed dividend was 0.05 per share, and there's retained earnings at the start of the year. So for this, I would like to tell you that the proposed dividend is basically that is supposed to be paid in the next year. It's just proposed in this year, so it is not included in this year calculation. Okay, so that is you need to know, and this is a format basically which helps you calculate the profit for the year or profit from operations, whatever is required to calculate. So this is the basic format which is also followed in statement of changes in equity, and this is the format through which you can calculate the retained earnings at the end of the year. So to solve this question, we have two ways. One is this method: you put down all these values, you can get profit for the year. The other is that you start with profit for the year, you subtract all those which needs to be subtracted, and you add all those which needs to be added. So they're both ways. I think this one is a bit easy. You can use the other way too, that you have all these things listed down. You have to just put the figures in and you can get to the answer. So we have add profit for the year, we have preference dividend, ordinary dividend subtracted, transfer to general reserve, interest paid, tax paid, and you get the retained earnings. Now if you look at the information, we are given retained earnings at the start, which are 195,000. We have profit for the year, which we need to calculate, can be written as X. The preference dividend was paid as 28,000. Ordinary dividend as 90,000. We will not include the proposed dividend. Then we do not have any transfer to general reserve. Do we have any interest paid? Acha, now look at in the information above. It says 7% 10-year debenture, and you have basically 300,000 that. So you take 300,000 into 7% gives you 21,000. So you are supposed to subtract the interest paid, 21,000. So all these are supposed to be subtracted. Do you have retained earnings at the end? Do you have the carry down? Now look at the information above. You were given retained earnings at 1st January, and at 31st December you were also given the retained earnings, which is 252,000. So this is basically the carry down. Now through backward working, you can calculate the profit for the year. I told you before in the last video that 252, you're going to add those which are being subtracted, and you're going to less those which are being added. So 252 plus 21,000 plus 90,000 plus 28,000 minus 195,000 gives you the profit from operations as 196,000. So this was the missing figure that you were supposed to. Alright, so now the next part is basically that market value of one ordinary share is 1.80 given, and you are supposed to calculate the following ratios to 2 decimal places. So the first one is ROCE. ROCE is basically return on capital employed. You do not just have to learn or learn the formulas. It's just that you have to understand them. So return on capital employed. So capital employed is the one which includes both the non-current liabilities, the equity, and everything in that is basically capital employed. Preference share, ordinary share, everything. And profit before interest and tax. Why is profit before interest and tax used and not after? Is the logic that you need to apply, because there are formulas which require after tax and which requires before tax, so you need to differentiate between them, because we're calculating the return on capital. So we will calculate the return before the subtraction of interest and tax, so we can get to know that the capital invested yields how much profit, so that can be distributed. So this is how you can learn each of the formulas. Now the profit before interest and tax is given as 196,000, because it is profit before interest and tax we calculated in the last part. Now we're supposed to write the capital employed. Capital employed is the addition of the equity and the non-current liability section. It is given as 1252000 plus the non-current liability. The 7% loan is 300,000 and into 100, because ROCE is calculated as a percentage of the capital employed, hence it is 12.63%. So do you get it? It is 12.36% is the profit that you yield on the capital employed in the business. So higher the ROCE, better for the business. The lower the ROCE, why? Because if the ROCE is higher, which it means that you are utilizing the capital more efficiently. So in questions you require the explanation of the ratios, so that will help you out. Now the second part is related to dividend cover. So dividend cover formula is profit after interest and tax divided by the total dividend paid, which is basically ordinary dividend paid. So profit after interest and tax is used in this formula. Why? Because ordinary dividend is paid after preference shares. So this is profit after interest, tax and preference dividend. Basically is the and you can add like after preference dividend. So then is dividend paid calculated. So this is how the formula works. Now the profit after interest and tax we need to calculate, because 196,000 was profit from operations. 21,000 was the interest paid that we calculated as 300 into 7%. And we're also supposed to subtract the preference dividend, as we stated, is 28,000. So this is profit after interest and tax in the calculation of dividend cover, and dividend paid was already stated as 90,000. So we are not supposed to include any. So 90,000 is given. Now we're going to calculate. We're not going to include the proposed dividend, and the total will be 1.63 times. So times also holds 1 mark, so you need to write the unit with it. Like for instance in rows it was a percentage, here it is times, and you also need to write only 2 decimal places answer, so you need to consider that. And also times is the one for which dividend cover is expressed in. The next up we have is dividend yield. So dividend yield formula is that dividend per share. Now this dividend per share includes both the proposed dividend and the dividend that you're paying in the current year. Why? Because that is the dividend that you've decided to pay per share. So it's not that you're going to differentiate between proposed, so you need to include the proposed dividend as well in this calculation, and then the market price per share, which is also stated in the question. So the dividend per share, we know that 0.05 was the one is the proposed dividend. Now how do we calculate the dividend that has been paid? They stated that they've paid 90,000 as ordinary dividend, and the total shares we had was 600,000. So you're supposed to calculate 90,000 divided by 600,000. How do we do this is, if you go back here, you see to calculate dividend per share, you do the total dividend paid divided by the total ordinary shares you have. So that is how you can calculate dividend per share. It is also used in other formulas. And that is how you can calculate dividend per share divided by the market price, as given as 1.80 into 100 will give you a total percentage of 11.11%. So basically this is the dividend yield that you were supposed to calculate, and you are also supposed to mention the percentage sign, which is extremely important. Now we have a gearing ratio. Gearing ratio is basically that shows the percentage of the non-current liabilities as part of the capital employed. For instance, if you have invested 100,000 as capital in the business, so you need to calculate how much is through the loan, how much have we taken from the bank or through preference shares or the debentures. So for instance, we say 50,000 is from the bank. So 50% will be your gearing ratio. So gearing is a part which is taken as a debenture or loan interest as part of the capital employed system. So non-current liabilities is a mix of debentures plus preference shares. So we have debentures of total of 300,000 and we have preference shares of 350,000. So these are the total non-current liabilities, and capital employed is both the non-current liabilities plus all the equity section that you have is basically 1252000 plus the 300,000 we have here. So if you look into, so this is the total, and now we will calculate the answer as 41.88%. So this is basically the gearing ratio. So if the gearing is above 50%, which means it is a highly geared company, which means most of the capital that is employed is through debentures and preference shares, which means that you have to supposed to pay higher interest rates and you will be left with lower profits at the end of the year. Hence, a lower gearing ratio can be below 50, which means it's low geared company, which means most of the capital is through ordinary shares, and there's low fixed interest rate that's supposed to pay. Higher profit means ordinary shares can be paid higher dividends, which means they will be happy and will be readily available to invest more into your company. So this is basically a small evaluation which you can write if it is required. Mostly it is required in the next part. Evaluate the figures that you've calculated and state reasons why that is so. So you can also write